Okay, you guys, we're now going to start with Chapter 2, and I thought we would begin by looking at the steps in the accounting cycle, and we're going to complete these by the end of Chapter 4. Let's look at what we've completed already. In Chapter 1, we looked at the financial statements and how they're put together. We'll work our way back to step number 8 in Chapters 2 through 4. They just like to show you those up front, so because we have to refer to them quite frequently, and that way you know what we're talking about. We're going to start in Chapter 2 with these steps. Transactions are analyzed and recorded in the journal. That's the journal would be the first place transactions are recorded in the accounting records. Then those transactions will be posted to the ledger. The ledger is just a separate space for each account that a business uses, and it tracks increases or decreases in that particular account. And those two steps are repeated throughout the year. Then when the business is ready to prepare financial statements, steps 3 through 10 would be completed. This step 5, of course, is optional. We will not be completing it. Or maybe we will. We'll see as we go. But these first two steps would happen continuously throughout the year. And the Chapter 2 problem will end up covering steps 1 through 3. Okay, so before you can make entries into the journal, there are a few things you'll have to memorize. First, given an account, you need to know what type of account that it is. You need to recognize that cash, accounts receivable, supplies, prepaid insurance, land, and office equipment, those are all asset accounts. I think cash is fairly self-explanatory. Accounts receivable, and the cash is usually tied to a checking account. Accounts receivable goes on the books when we provide goods or services to a customer today, and they promise to pay in the very near future, usually 30 to 60 days. Supplies would be things like office supplies. Prepaid insurance would be if we had paid our insurance ahead for a period of time. We have the future benefit there of insurance coverage. I think land and office equipment are fairly self-explanatory. Assets are just property owned by the business or anything of future benefit to the business. Liabilities represent debts or future obligations. And liabilities also represent claims of creditors to the assets of the business. One common one would be accounts payable. It comes up when we purchase goods or services and we are provided with them today, and we promise to pay in the very near future, usually 30 to 60 days. Notes payable, we use that when we borrow money to represent the balance of the loan. So notes payable and accounts payable are both debts. Unearned rent is a little different. It would only show up on the books of a landlord if they receive rent prior to having earned it. So if a tenant comes in and pays their next year's rent in advance, cash of the business would increase, but we can't call it rent revenue yet because we haven't earned it. So it creates a liability for us, unearned rent. We're taking on a future obligation there to either let the tenant occupy the space or give them their money back. Your stockholders' equity accounts, common stock and retained earnings are both stockholders' equity accounts. Then dividends, which would be a return of the profits to the shareholders, actually a contra stockholders' equity account. We'll talk about that, why that matters, coming up in this video. Our revenue accounts we'll deal with here early on are fees earned. That's the revenue account we use for a service business. Also in the books of a landlord you could see rent revenue. And then we had several different expenses. I listed salary and commission expense, wages expense, supplies expense, rent expense, advertising expense, automobile expense, utilities expense, taxes expense, and miscellaneous expense. Those, of course, are all expense accounts. So when I say you need to memorize this, given an account, you need to recognize what type of account it is. So if I say prepaid insurance, you need to recognize that that's an asset. You need to recognize that fees earned is a revenue account, so forth and so on. You need to know unearned rent's a liability, that kind of thing. Okay. Also, you'll need to commit to memory our system of debits and credits. Now, going into the course, you probably have a definition in your mind already of the word debit and of the word credit. You might think of credit as related to a credit card or receiving credit for something. If you look at it from a bank statement perspective, you might think of it as deposits into a checking account. Debit, you're probably most familiar with that term in the as it's used with a debit card. But you guys forget about those definitions of the words debit and credit for our purposes. For our purposes, debit and credit just mean either an increase in an account or a decrease in an account. Now, the left side of each account is the debit side. The right side is the credit side. So some accounts will increase on the debit side, like assets, and those will decrease, of course, on the credit side. Other accounts will work the opposite way. Liabilities increase on the credit side and decrease on the debit side. So it depends on what type of account you're talking about. So you got to commit this system to memory as well. I'll first set it up this way. But assets, dividends, and expenses all increase on the debit side and decrease on the credit side. Liabilities, common stock, retained earnings, and revenues all increase on the credit side and decrease on the debit side. An easy way to memorize it might be like this. Assets, dividends, and expenses all increase on the debit side, decrease on the credit side. While the other four, liabilities, common stock, retained earnings, and revenues, all increase as credits and decrease as debits. Now you'll see soon how these are entered into the process. I'm not just asking you to memorize this to give you something to do. To be able to make journal entries, you guys, which is this first step in the accounting cycle, transactions are analyzed and recorded in the journal. To be able to make those, you first have to know, given an account, what type of account is it. Then you'll read a transaction, pick out the accounts affected. Then for each account affected, you'll decide whether the account increased or decreased. And you can enter it into the journal using this system of debits and credits. For instance, if an asset account increased, it would be entered as a debit. At the same time, if a liability account increased, it would be entered in the journal as a credit. So we're about to work through some examples. We're going to do exercise 2-7. Or we'll do a journal entry exercise for sure, and you'll see how this system works. Okay, thanks.